So good morning, everyone. I'm Ian. As Maciek mentioned, I used to head up business development for Consensus, looking after MetaMask, Linear, and a number of other products. Nice to see one of my ex-colleagues here, Toby from Diligence. So it's good to see an Edinburgh community building up. I think before we start, I just wanted to say a big thank you to Maciek, for first of all setting this up. I'm really pumped. I've only been in Edinburgh for just over a year, and I'm really pumped to see us hosting an event like this. And secondly, for all your efforts in running the Blockchain Scotland meetups, which I know is a huge amount. So maybe we just give a quick applause to Maciek for all the effort he does. So thank you. I'm going to talk to you about tokenization and DeFi, but rather than just sort of going through the dry sort of mechanics of tokenization and what happens there, I'm also going to give you some anecdotes and tell you a bit of a story about my own experience in tokenizing a $2 billion token and having to deal with a very large airdrop. It was about 15%, and also handling about $200 million of day one sell pressure. So just sort of give you a sense of the experience that I went through and the sort of the hurdles and the challenges and the lessons learned. Unfortunately, the clicker's not giving me. Sorry, really hard. Okay, there we go. I guess the first message is that I think we're evolving from an era of high speculation and a lot of, and you could see it on crypto Twitter, you could see it with all of the meme coins, with all of the enormous number of sort of speculative VC coins that were being pushed out over the last few years. And now we're sort of maturing into what I would say is a more limited and serious cohort of digital assets that retain value, or most of them should retain value, and some of them will accrue value, but it will be a lot more selective. And so, just aping into everything isn't going to work as a strategy going forward. And the message is to consider very carefully why you're tokenizing something. In terms of the life cycle of the digital asset, I've sort of mapped out 6 stages. I wouldn't say this is each stage doesn't apply to every single token, because the decisions that you take at the beginning of the journey will define whether you can start to do activities in the latter part of the journey. And that will just depend on as Maciek talked about, why, what is the use case for tokenization. So if it's for sort of internal cash management perspectives, you might not need to worry about composability in secondary markets. But if it's about using a real-world asset as collateral inside DeFi, you do need to think about these things. So we start off with origination, which is, on the crypto native side, is how are you going to define the tokenization for your asset, or it might be how are you going to structure a real-world product into a tokenized digital asset form. Then you've got to issue it either through a sort of smart contract or through directly or through a platform. You'll then want to distribute it to your primary holders. If you do have the ability to make it composable, which is one of the big advantages of tokenization, then you'll sort of investigate what you can do with it in DeFi and make it available on secondary markets to be able to trade more freely globally, because blockchain networks give us this amazing global audience. And lastly, for more of the sort of financial instruments and real-world assets, what are the redemption approaches? Now, with a crypto native token, you obviously wouldn't have redemption, but with a real-world asset, you would have to think about a redemption process. So on the origination step, on the crypto native side, you typically write a white paper, you have your tokenomics. When I launched the Linear Layer 2, we worked on a tokenomics document and a sort of quite sophisticated spreadsheet showing the issuance over time to satisfy the markets that were going to accept this token. And on the real world asset side, you've got to decide whether you're going to issue the token natively or whether you're going to wrap. Now, wrapping has been the first sort of where the first set of real world assets have arisen. And that's basically, the asset is custodied somewhere, and you're basically trusting that custody provider or that SPV to hold the underlying asset for you. And the wrapper basically is a loose claim, let's say. It depends on the legal terms, but it's a loose claim on the token. Or you can actually make the token itself and the blockchain record itself as a representation. So it's a legal framework that recognizes the on-chain record and is the primary registry. And I think over time, this will be the future of where real-world asset tokenization lands, because at the end of the day, we don't want to have all of these different trust assumptions layered underneath the token. But for now, these seem to be working. Tether and Ondo are doing a fantastic job. There's plenty of other wrapped tokens. On the issuance side, as I said, you can start with get a Solidity developer or another smart contract developer to come in and write your smart contract, get it audited, and issue and mint the token. Or you can go via a tokenization platform, which tends to layer in sort of more institutional requirements. So it might be, to manage investor onboarding, or you might want to think about how you're going to KYC and make sure that you're following sort of anti-money laundering rules and regulations, that you've got sort of an underlying set of security principles. You might want to, your platform to use, formal verification and have certain levels of audits and so on in there. And it's interesting that I think tokenization has become made available from different players. They offer similar things, but they're not all identical. So you've got sort of issuers who tend to wrap. You've got sort of more from the infrastructure and compliance space, where they offer the ability to tokenize, but also to do other services. Like with Centrifuge, they also offer the ability to have infrastructure for vault management, for example. You've got your regulated venues that are starting to offer tokenization services. So like, for example, Connexus started off with the Quorum private blockchain, but now sort of offer tokenization services on top of that. And the custodians themselves, so GK8 from Galaxy, and more recently, Bank of New York Mellon have also launched their tokenization platform off the back of their history of custodying assets. On the distribution side, so I think there's two aspects to distribution. One is, how do you get the token into the hands of like primary users? And then there's a secondary sort of phase around secondary distribution, which we'll talk about a little bit later in the presentation. But for the crypto native assets, you basically there's many different ways to distribute. You can give things away through airdrops. My experience is avoid that like the plague. It's a very stressful and a difficult approach to take. I'll talk a little bit about that in a minute. Actually, maybe I'll talk about it now. My experience with the linear airdrop was, first of all, the ecosystem gets very toxic very quickly if you overpromise anything at all. And so if you do consider an airdrop, set the expectations as low as possible right from the onset, and be very careful about building any sort of expectation. But regardless, the entirety of crypto Twitter will jump on you and fudge you out of existence if you're not careful. So airdrops, proceed with caution. And that goes for airdrops to retail or airdrops to big liquidity providers as well. For me, it was a similar sort of experience. I also, pre-sales are another mechanism where you can sort of commit to distributing tokens at a discount to people who are interested in participating early prior to the minting of the token. Once again, that, proceed with caution, because that can create unnecessary sell pressure after you've launched your token. But it can also be a source of building treasury before you mint. In Linear's case, we focused on the airdrop to try to build the ecosystem, and then we focused on treasury management and building the treasury after we minted the token. So we didn't do a pre-sale. I don't think there's one rule about what's right or what's not right in the crypto native space. I think it depends on the use case and the specificity of the token itself and the tokenomics, but and what type of ecosystem and what type of community you're building. But it requires a lot of attention and a lot of thought ahead of schedule. For the institutions, you've got private placements with investors, or you can also offer the token through regulated offerings like Archax, and then have direct issuance as well. On the secondary distribution channel, there's all sorts of different opportunities to get the token distributed. I'll talk a little bit about this in stage 5, so let's skip over that. But just remember that there's a lot of different players you should be talking to get your token accepted and trading. So now we're going on to what Maciek really wanted me to sort of dive into the meat of, which was composability in DeFi, right? And there's a lot of text here, so I'm not going to ask you to read it all, but just bear in mind that DeFi includes lots of different approaches that you can take to make use of the token. And some of these build on top of each other. So for example, you could have a staking offering that allows token holders to stake the token. They receive a liquid staking token in return, which they could then deposit into markets, and then they can trade as well. So you sort of start to build Lego blocks on top of each other with DeFi. And I think there's also sort of emerging technologies that are becoming very interesting, like perpetual markets, where you don't actually have to give the token over to the perpetual market, but they will create a perpetual market for you, which basically allows sort of like a futures derivatives trading market setup. And what's interesting is that they're becoming they're 24/7, which allows for a lot of interesting RWA trading. We'll talk about that in a minute. And prediction markets, which are an upcoming sort of test of what's the truth, and people putting their money in to see what's the real outcome of a real world event. And this isn't exhaustive, but I've sort of tried to pick 2 or 3 of the leading logos in each space. And I think the message from this is that, and everyone's going to debate and say I've picked the wrong ones. So I can already see half the audience going, oh, that's the wrong one. But I think the message from here is that if you are issuing a token, you need to have a lot of conversations with a lot of different players to get that token accepted within DeFi, and you need to pick the right paths. And as I said, there's probably another 20 options on all of these which you could discuss with. And so it depends on how, and then there's also different approaches. So if you want to get your token available on Aave, if it's permissionless, then you have to go through the Aave DAO. If it's permissioned, you'd have to speak to Aave Labs about getting it available on Horizon. And so there's all these sort of different conversations you need to have with different groups and people to get the token made available through DeFi. On the secondary market side, there's lots of different other, and so we're just going to go through logos after logos now. But this has been my life. Like, when we launched Linea, I had to have conversations with 40 centralized exchanges. I had to have conversations with over 10 custodians. I had to have conversations with, 4 compliance providers, about 6 security providers. It's the list of people that you have to speak to is enormous for getting these tokens out there. And so let's start with custody. So, how does a user hold the token itself? If you're a serious institutional RWA and you don't have your token made available through Coinbase Custody, Coinbase Prime, or Anchorage Digital, I would say it's not serious, right? If you want your crypto native token available to centralized exchanges and you don't have Firebox support, once again, you're not going to get the listings. So there's a lot of conversations you need to have, like just to give you a base to be able to get even to secondary distribution. And then you've got to think about how is the value of that token backed and exposed to the market. Maciek talked about oracles and how they're really important to give a NAV. You've also got to be very, very careful with your oracle provider and maybe have a backup, because we've seen a lot of security attacks where people try to manipulate oracles. And then the last thing you want to do is to have a sort of cascading liquidation of your token because someone's manipulated your oracle and all of your users are being liquidated on Aave or some other credit market or Morpho or whatever. As I mentioned, on the centralized exchange side, on the crypto native side, because we had such a large airdrop with 15%, we ended up needing to absorb most of that being sold on day one and day two. And, we had to set up market making to ensure that there was liquidity. And we'll talk about that in the next slide, the next couple of slides. But we also had to ensure that the token was available on the most important venues to be able to absorb that type of sell pressure. We didn't want to lock the token. You could lock the token, but we didn't want to lock the token. And I would say as a crypto native token, if these would be the only venues that I would spend my time and effort on. If you're a large crypto native token, these are the ones that get like 95% of the volume. Maybe you could argue there might be a couple of others there, but, and I wouldn't underestimate the importance of the Korean exchanges, which they gave us 30% of our volume. So between Upbit and BitThumb, they were a huge amount of volume and trading liquidity. And by getting all of these listed, we were able to absorb and allow the airdrop hunters who had been working for like 2+ years on our ecosystem to then have their exit and sell to retail. And there's lots of different ways of getting those listings. You can either set up direct, deals with the exchanges, or you can sort of co-marketing, or you just basically hold fast and say, I'm not going to give you any distribution. I'm not going to give you any free tokens. Just list me and see how you go. For Linea, for example, we ended up doing an allocation to Binance and OKX, and we found that with that, everyone else followed. I'm also seeing that with listing agreements prior to October the 10th, when we had the big Binance liquidity event, a lot of the minimum deal you would tend to get was somewhere between 2 to 3% of your allocation would have to be given to Binance for them to distribute to their users. Now that's come tumbling down. So I think the level of allocation that you need to give to Binance is much, much lower. In hindsight, I wish we hadn't done the airdrop so aggressively, because that would have avoided us having to give what ended up being almost like $60 million worth of tokens to Binance users. So in hindsight, I wouldn't have done that. But, it's easy to look back. So I'd be very careful about giving free tokens out anywhere. Airdrops, centralized exchanges, protect your tokens and your token holders is what the message is. And then on the real world asset side of things, secondary markets are emerging, and also we're seeing the trading desks and market makers evolving to be able to support RWAs, but it's still early days. I feel it's very early still. I'm sure there's a lot more better educated people that can talk through these, but just throwing out a couple, Archax and 21X are sort of venues where you can have your RWA traded within a regulated environment. On the market making side, I have seen a massive shift from just, trading desks providing liquidity and OTC services and maybe a little bit of treasury management to now providing like a full, almost like investment bank-like service. And so, typically when you're launching a crypto native token, you will basically offer a loan of your tokens for a certain amount of time to allow them to market make. So you give the market maker a small percentage of your tokens and they will be able to trade those tokens in exchange for giving you a certain amount of liquidity of their US dollar stablecoins. And they'll then make the market. So they'll provide a bid and an ask and ensure that there's tight spreads on the secondary venues, on the centralized exchanges and on the DEXs. But what's interesting is that they're now starting to evolve that model from just, you do a sort of loan option model where they have, you give them a loan of tokens, they have the option to buy those tokens at the end of the year, to much more advanced sort of underwriting services where they're underwriting the entirety of the launch, almost like a proper IPO. So I'm seeing that evolution from sort of what I'd say is a bit sort of more parasitic sort of market-making behavior towards really professionalized investment banking type services. And that involves, helping you at the venture side, building up an ecosystem, helping you with sales and trading of your token, through to managing your treasury, and then helping you with like M&A and all sorts of other insurance products. So it's becoming a lot more sophisticated, but market making is once again a huge piece of the pie for both crypto native and RWAs, because without liquidity, the token's dead and no one can trade it and no one can sell it. On the crypto native side, we did an RFP, issued it to 15 market makers, selected 8, and then ended up picking 5 in the end, or sort of shortlisted 8 and then picked 5 to go with. These are some of the names that I would recommend working with. I've had good experiences with them. What's interesting is some of the more institutional market makers are now coming in and offering very, very competitive services with big liquidity depth. And so what I've seen is like the likes of Falcon X and Susquehanna, for example, have been providing very, very competitive offers for things like options and puts and so on for treasury management. So I think it's really telling that these players have like come in force. And I think the biggest tell will be when the really big boys turn up and start to offer services. They're not quite there yet, but other players like Jump Trading are there. So I expect this to happen relatively soon. But that will be the sort of final sort of stamp of approval for me in terms of like the most serious market-making players in the industry are taking crypto really seriously. And then last of all, redemption. So how do you trade out of the token? Obviously, with a crypto native token, that doesn't happen. But for things like wrap tokens, you would want to redeem by actually burning the token and then making the underlying asset available to the user or giving them fiat in exchange or stables. The challenge here is like with real-world assets, like Maciek was talking to you about settlement. If you've got an asset that settles T+2, in the blockchain world, you really need to be thinking T+0. And so you want to be able to offer a sort of much shorter duration, maybe with liquidity buffers. It does involve somebody taking risk, but I would definitely recommend for any RWA looking at maybe some sort of percentage of the RWA being available through a liquidity buffer. And that can be done through these sort of more sophisticated market-making agreements. And then in terms of the burn mechanics, you can choose how you burn, whether it's like automatic through a smart contract or whether you have some sort of human oversight to check whether the person's valid to be receiving the underlying. And good examples of redemptions are the likes of Circle and USDC, where you basically can take your USDC token and then convert it to fiat in your Circle account. So on the DeFi side, one of the messages that, so I've been doing a bit of research. I've spoken to about 50 people over the last month and a half in the industry across AI, crypto, and security. And I'm sort of trying to understand what's been going on. I've been working quite a bit with Toby as well, discussing what's been happening. And DeFi has this superpower of stacking utility, and you compound this utility by being able to use the token in different ways. And so it provides a lot of capital efficiency, liquidity. and there's all this innovation velocity that's happening on the crypto side. But, April was a really telling month for DeFi. We had unprecedented numbers of attacks, and I think since Opus 4.6, and what's happening also on the open source models is, AI has been aggressively used by malicious actors to attack DeFi. And DeFi has almost become like this sort of, permissionless bug bounty program where black hats can try to target funds. So, first of all, when you're considering a tokenization journey, security must be absolutely the #1 thing you think about. Without security, you've got nothing. I've always talked about this at the MetaMask level with the wallet. Without security, our wallet was worth nothing. And we always took that as the #1 thing, over usability, over functionality. But the challenge is that with AI, AI, I think, expands the attack surface because we are in the most adversarial environment. I did a talk a while back about security, but it's open source, it's fully visible. Sorry, I'm going a little bit over. They're public networks. Attackers can come in and out when they like. We have to get it right 100% of the time. And from a security perspective, the attacker only has to do one exploit, and they can exploit in so many different ways. Admin keys, Oracle exploits, et cetera, et cetera. So take security really, really seriously because AI is industrializing attacks. And I think the conclusion that I've sort of come to over my recent research is I think liquidity does gravitate to simpler DeFi for now, and that all of these sort of more sophisticated Lego blocks will take time to prove out whether they can sort of be hardened and be robust against this AI attack. And so I've just sort of thrown out a few examples of protocols that I think are winning at the moment. Lido have got I think about 70% of liquid staking on Ethereum. Aave is I think last time I presented it was roughly about the sort of 50th largest bank in America. And Hyperliquid is absolutely killing it in terms of trading volume for out of hours, gold, oil, especially oil recently they've gone crazy with that. Most of crypto traders have moved over to real world assets on Hyperliquid. Tokenization is definitely happening. It's something that we need to be focused on. DeFi is where I think you can make value. Why tokenize if you're not using DeFi? But think about how you work with all of these different players in the ecosystem to capture the value and make sure that your token succeeds. As I said, we're here helping projects with their tokenization strategies and institutions with their tokenization strategies. So please reach out, and I'd be very happy to discuss what you're trying to do. Thank you.